If you're listening to this episode on the day it was released, congratulations. That means you still have time to register for tomorrow's live YMYW webinar happening at noon Pacific, 3 p.m. Eastern. Once again, Joe and Big Al will be answering your money questions live on camera for free and just for YMYW listeners. Sign up in the podcast show notes. Click the link in the description of today's episode in your podcast app to get there. Today on Your Money, Your Wealth, we're talking all about Roth rules, contribution rules, withdrawal rules, safe harbor rules, pro-rata and aggregation rules. Joe and Big Al will explain them and how they apply to both traditional retirement plans and to accounts like SEP IRAs and thrift savings plans. Plus, the fellas break down the small cap, mid cap, large cap, value, and growth asset classes. And we wrap up with a giant derail about getting a haircut. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
We got David from NYC. He writes in, "Hi all, I have a question about paying estimated federal income taxes in the safe harbor rule. My situation is brief," as he writes us a full page.
1, 2, 3 paragraphs.
I'm retired and getting Social Security, 85% of which is taxable, and my wife is still working. With those two income streams, plus cap gains, dividend distributions, and interest minus deductions, our taxable income was about $130,000, so we're in the 22% tax bracket. For 2020, because during the first 3 months of this year, I did a little over $20,000 conversion, almost all fully taxable due to the pro-rata rule. And because I expect much larger capital gain distributions from some actively managed mutual funds in our taxable account, thanks to the volatility this year and the ongoing outflows, our taxable income should end up just about at the top of the 22% tax bracket or a tiny bit above, at $171,000 and some change. Okay, based on my wife's pay stubs, it's easy to figure out roughly what her 2020 federal withholdings will be. If the safe harbor for our tax liability for 2020 is paying at least 110% of the 2019 tax, it seems the estimated tax would be a simple calculation of the difference between 110% times 2019 tax minus projected 2020 federal withholding, paid equally over 4 quarters. But what if those cap gain distributions are much higher than I expect, and taxable income ends up closer to 190? In some years like this, distributions have been ridiculously high. That's why I'm trying to transition out of active funds. Am I still protected against an IRS penalty by relying on that simple formula? By the way, I have New York State and city income taxes to worry about too, but I'll leave those aside for now. Hope I provided enough info to get your sage advice. Thought I was going to say SAG.
Sage.
Sage.
We're sage advisors.
Thanks. I've been listening to your podcast for a year or so now, and I always find it informative and fun. Well, thank you, David from NYC. Hopefully you're safe in the epicenter.
All right. Well, we'll break this down a little bit. So what David is saying is he thinks his income tax will be higher this year because of his Roth conversion and maybe higher capital gains taxes. So he's wondering if he can rely on that rule that we've talked about, which is to base your estimated payments or withholdings on last year's tax. And so the rule is pretty simple. You take last year's tax, and if you have enough in withholdings, you're fine. Now, if your income is over $150,000, which it appears that David's is, based upon his taxable income numbers, then you have to take it times 110%. So what that means is, let's just say your taxes are $20,000 times 110%. So $22,000 is your number. If your withholding is $15,000, just to make up a number, so you're short $7,000. David, what you said is exactly right. You take that $7,000 divided by 4 quarterly payments, and that's what you make over the rest of the year. That's regardless of your capital gains. Your capital gains could be $2 million. It doesn't matter. As long as you paid in 110% of last year's tax, you're covered. Now, certainly you do owe the tax on April 15th of next year, so be ready for that big liability, but you don't necessarily have to pay it early.
So the estimated taxes is always, if it's over $150,000 of income, taxable income or adjusted gross?
Adjusted gross.
So then, as long as they pay 110% of last year's,
Yes.
and they could have triple the income this year.
Yeah. It doesn't matter.
As long as they pay 110% and then pay the tax due on April 15th, they're good.
And so the IRS doesn't care if it's a withholding or an estimated payment. They're indifferent. That's why you look at those together. So you take the 110% times your tax, that's your number. Then you look at what your expected withholding is. If your withholding is more than 110% of your tax, you're done, right? If your withholding is less than 110% of your tax, then you take the difference and divide it by 4 and pay that in quarterly payments. The only exception to that is if your taxes are actually going down as opposed to going up, right? So in other words, if 2020, your taxes will be lower than 2019, now you can base it on the current year, as long as you're paying 90% of the current year. But I almost hate to say that rule because people get too confused. But that's only when your taxes are lower for the current year.
So what's the deal like when people are getting penalized because certain income shows up at certain parts of the year?
Oh, that's a good point. That is true. So let's say you do your Roth conversion now. So we're recording this in May, right? So your next estimated payment in May is June 15th. But what if you just did it? Then you didn't know about it on April 15th. Then you just fill out the IRS penalty form. Next year with your return, it's Form 2210. And you use what's called the annualization method to show when your income spiked. And so basically, if you did a conversion now, then you'd basically have to make a double estimated payment in June as a catch-up, but you'll still avoid penalty. Okay, and then you'll make a regular estimated payment for the third and fourth quarter. That makes sense?
Not even close.
Well, here's my tip for you. After we're done, rewind the tape, listen to it slowly.
Because before you said you could just divide it by 4.
Well, yeah, you can. But if you're into the year and you've already missed the first payment, you have to have a little bit different method. That's why this gets so confusing, right?
Got it. Okay.
Then when I throw in the 90% of this year's tax, people stop listening, including you.
Yes. So now people are getting kind of creative with the names here.
I've noticed that. I like it.
I don't know if I care for it that much.
I like it.
So we got Elwood Blues.
That's perfect.
You know, the crazy thing is he's from Missouri, not Chicago.
Right, exactly.
Yeah. Well,
maybe Elwood moved
to
Missouri
on his road trip.
Was Elwood Belushi, or was that Aykroyd?
I don't remember.
I think it was Belushi, but that's a 50-50 guess.
Because it was Jake and Elwood, right? Wasn't that their names?
Yeah, I'm just trying to think of the tattoos on their hands.
Maybe it was Aykroyd then. If it was, I don't know. Who knows?
I think it was Aykroyd.
It was Aykroyd.
Okay.
Yeah. I just looked it up.
So this.
Okay. And he's got another name for you too.
Yeah, I understand. I just saw that right now. Hello, Big Al, Miss Andy, and Cousin Eddie. I mean Joe. Where the hell's Cousin Eddie coming from?
I don't know.
I'm gonna come to his house with a trailer. I mean, with the RV.
You should, right?
Dump my RV right.
Right. You gotta come show up at Christmas with no presents for the kids.
Yeah. Well, I might give him a nice white pair of shoes. Real potato ketchup, Eddie? Nothing but the best.
Apparently you are Cousin Eddie.
He still liked that turkey, even though it was overdone. I do remember that.
Yeah, when they cut it, the thing just exploded.
And they were all eating the bones.
Ooh, a little dry. All right. I have a question for you, and I will try to give you as much detail as I can. All I ask is that you shorten it up or word it a little better if you use it on the podcast, which I hope you do. Well, there, Elwood.
I don't think we did.
We're not shortening this thing up, and I'm going to butcher the hell out of this. And we're going to go. We're going to do it together. All right. On January 1st, 2021, my company will be stopping our current pension plan and offering the lump sum pay of which I will take. So he's taking the lump sum versus the annuity, which would be an income stream. I don't know the exact number, but let's just assume $300,000. I will have it transferred to my IRA and keep making contributions one question is when I do finalize, one question is when I do have this finalized in the IRA, can I then make the $6,000 contribution for 21 on top of it? Yes, of course. Okay, so that's the question is he's going to roll the lump sum into an IRA. And so, since the lump sum is $300,000, Elwood here is curious if he can still continue to make his annual contribution into the IRA, or does the lump sum count as a contribution amount?
Yes, and it doesn't. So you're right. So you can go ahead and make that $6,000 contribution, and the lump sum payout will be in 2021. So you can do the IRA contribution for 2021.
Yes, and then so you can make the 2020 contribution as well in April, all the way to April of next year.
Yeah, which I think is his next point.
So he could do both. He can do the 2020, 2021 in April of next year, and do the $300,000 roll from the defined benefit plan into the IRA.
Yeah, exactly. Which is a good idea. I agree.
All right. Here's the other part of this. I also have a Roth IRA opened 5 years ago. Am I able to make this transfer into the traditional IRA, but then have some of it transferred to the Roth IRA? I understand I would have to pay taxes on this amount, but is it possible? And if so, am I able to take the money from the Roth, let's say a month later for whatever? All right, so he's got a Roth IRA. He's concerned about the 5-year clock. And so what the 5-year rule is on a Roth IRA is that the money that you put in a Roth IRA has FIFO tax treatment, first in, first out. So the dollars that he's made as contributions can be pulled out. The 5-year clock really has to do with 59 and a half. So I don't know how old Elwood Blues is, but if he's using the Blues Brothers and cousin Eddie.
Well, he's probably under 50 because he's using a $6,000 contribution.
He says if you read a little further down, he says he's age 44, married, gross income 125K.
Thank you, Andy.
Somebody's got to read them.
I suppose we could have probably been prepared and read the whole email before we go live on this. So no, he's 44. So the 59, he could take contributions only. So just FYI, he wants to do a conversion of this money. He can do a conversion of the money, but no, he can't have access to the converted money for 5 years. So if you convert under 59 and a half, you have a 5-year clock on each of the conversion dollar until you turn 59 and a half. So they don't want you to convert and then take money out the next year, because then that avoids the 10% early withdrawal penalty. So they want you to season the money in the Roth from a conversion for 5 years. Your contributions are available right away. The growth on the Roth IRA dollars is 5 years or 59 and a half, whichever is longer. So if you do a conversion and you need the money, you have to wait 5 years until you're 49 to take the converted dollars, right? And then you got to wait till 59 and a half to take the earnings out.
Yeah, that's right. But let's just say you've done $40,000 in prior contributions.
He's got access to that.
You can take that anytime. In fact, as soon as you do a contribution, you can take it out the next day, no problem, any age. It's just that conversion. You got to wait 5 years. And then the income part, as you said, Joe, 59 and a half.
Okay. If this is possible, could you please go over these steps with some detail, how to make this happen? Like how to pay the taxes when putting them on in the Roth. Can you transfer any amount into the Roth if you're willing to pay the taxes on it? Yes. So any dollar you could, the conversion amount is unlimited. So let's say the $300,000 you get from your lump sum, you roll that into the IRA, you make another $12,000 contribution on top of that. And then you want to do a Roth IRA conversion. You can do the conversion up to any dollar amount. Just know that the taxes will be owed the next year. You don't want to withhold taxes from doing a Roth conversion, especially when you're under 59 and a half, because you're 44. If you withhold taxes by doing a conversion, for instance, you convert $100,000 and withhold 20% or $20,000 to pay the tax. Well, that $20,000 is also going to be assessed a 10% penalty because that doesn't qualify as a legal distribution, if you will, or a qualified distribution from a retirement account, because you're taking that out to pay taxes on a conversion. So
yeah, so you pay tax on the 20,000 plus a penalty on the 20,000 both.
yeah,
And federal and state.
so that's a huge blow up. So you got to be really careful about how you do these conversions. We've seen a lot of different mistakes throughout the years. So you want to do a straight conversion and then just pay the tax outside. So if you're willing to pay the tax, then by all means, go for it. But what confuses me, I guess, with Elwood Blues here is that he wants to make $12,000 contributions to IRAs. Maybe he does the $12,000 to Roth IRAs.
Yeah, I was
So-
just thinking the same thing. That'd be much smarter and do a smaller conversion. That way you have access to that $12,000 if you need it, if something happens.
So current age, 44, married. My gross income, 125. So gross income, depending on, with that type of income too, I'd do Roth IRA.
Yeah, me too.
Wife, substitute teacher, maybe $10,000. I do have a 401k at work that I started maxing out about 3 years ago. Pension buyout could be around 300K. He's got 235 in a traditional IRA. The remaining into the Roth IRA minus taxes. When can I have access to the money in the Roth?
So he's saying the pension
So
buyout, he wants to
300,000, put 235 into the traditional IRA, put the
rest
remaining
into
in the
the
Roth
Roth.
IRA minus taxes. No, don't do that, Elwood. You're gonna blow yourself up, brother. Even though you're calling me Cousin Eddie, I just saved you probably like $30,000 in unnecessary tax.
Agreed. You know, I don't know about Missouri taxes, but in California, if you were to do this, you'd pay the federal and state tax plus penalty to feds and penalty to state. For a lot of people, it comes out to about 50% in taxes when you add all those together. It's just a complete waste of money.
Yeah, you'll blow yourself up. Do not withhold taxes by doing this. Say, all right, well, here, with this $300,000, I'm going to put $235,000 in this, and then, withhold some taxes, and then put the rest in the Roth IRA. No, absolutely not. That will, because the withholdings is what's going to blow you up, and then the next year you're going to have penalties and the pay tax upon the tax. I mean, it would be a nightmare.
You know, we in almost all cases don't want people to withhold on a Roth conversion, but especially when you're under 59 and a half, it makes virtually no sense.
Yes, 0 cents. So put everything into the IRA, right? And then you take a look at 125. He's got room. He's got $50,000 of room if he wanted to do a $50,000 conversion in that 22% tax bracket. So then convert 50 grand and just know you're going to owe $10,000, right, next April by doing the $50,000 conversion. So you want to make sure that you have $10,000 or something like that of liquid cash flow to do it, or change your withholdings or something like that.
Yeah, so here's a
If
thought.
that tax bite is too high, then you'd probably do something lower, right?
Here's a thought. Why not, instead of making the Roth contribution, just keep that money for the taxes. You're paying the taxes with that same money. You're getting 50 grand in instead of 12 grand.
Yeah. So in other words, you got $12,000 right now that you were going to put in IRAs. Keep the $12,000 in cash and convert $50,000. Take the $12,000 that you were going to put into Roth, just pay that to the IRS to get the $50,000 in.
Now you use that same 12 grand to get 50 in. I like the math better.
Yeah, you're leveraging the taxes.
Yeah, right.
Okay, so I hope this makes some sense. And I would be there. A lot of people that might run out with companies getting away of their pensions.
I think that was Bet.
I have no idea. Elwood. I mean, I don't know. Maybe he was a little buzzed when he wrote this email to us. Doesn't Elwood like to sip on the little candy sauce?
Yeah, is that what Missouri has?
Well, I don't know. I could go for some candy sauce right now.
Hey, Elwood, if you haven't yet downloaded our guide to the 5-year rules for Roth IRA withdrawals, do it now. It lays out the confusing 5-year Roth clocks and tells you what you can and can't do in an easy-to-read format based on your age and circumstances. Then pass that guide on to someone else and tell them you got this great information from Joe and Big Al and that they really should subscribe to the Your Money, Your Wealth podcast. To download the 5-year Roth Clock Guide, click the link in the description of today's episode in your podcast app to go to the show notes at yourmoneyyourwealth.com and click the banner that says the 5-year rules for Roth IRA withdrawals. If you've still got questions, that's perfectly understandable. Click the banner that says Ask Joe and Al on air and send in your questions in a voice message or an email.
We got Tim. He writes in from San Diego, Al.
Okay, let's hear.
He goes, "Hi, Joe and Big Al. The last response I heard from you regarding rollover caused me some concern. Maybe I just misheard it. I transferred a portion of my TSP IRA to my bank and the next day took a check to the custodian of my Roth. Did I hear correct that the IRS may consider that I touched the funds and get some sort of big penalty, even though I put the funds into my Roth in much less than 60 days? Some history. For 2018, I did an electronic transfer from my TSP to my Roth late in the year around September, but the TSP would not withhold taxes, so the IRS sent me a penalty bill, which I appealed and won. For 2019, I thought, lesson learned, and I had the TSP transfer enough to stay within the 24% tax bracket to my bank. TSP withheld taxes, then I took a check to put the after-tax remainder in my Roth in less than 60 days. Sorry for the lengthy question. I enjoy the TV and webcast. Okay, so TSP has some funky rules in regards to distributions from the overall TSP. And what Tim is doing is a 60-day rollover in regards to the TSP. But I have no idea how old he is, and I'm not sure why he's doing it this way. Because the TSP won't go to the Roth component of it. So he's saying, all right, I'm just going to take a distribution and I'm going to roll it back within 60 days, but he's withholding taxes.
Right. So he has to get other money to make it whole. So I actually think this works.
Yeah, it's fine. But if he doesn't, but why he's withholding taxes to pay for the conversion, but now he's got to pay the IRA back to make him whole. And if he's under 59 and a half, he's going to get a 10% penalty.
Yeah, that would be true. So,
and taxable.
Yeah, and taxable. Yeah,
so
taxable
if he's doing a conversion
penalty.
And he's withholding 24% from with the conversion.
So
he's, let's just say 100,000, roughly 24,000 he's withholding.
Yeah, okay.
$76,000 is what he's putting into the Roth IRA, even though he took a distribution on 100,000.
Right.
If he's under 59 and a half, right? So he's rolling the $76,000 back into the Roth within the 60-day period, which he can do.
Right.
But he's then withholding taxes on the conversion, and then if he's under 59 and a half, that 24 grand's got a 10% penalty.
But don't you think it doesn't, because he got the whole amount back into the
He's
Roth.
not putting the whole amount. He's not putting 100,000 in the Roth.
That's how I read it. I think he's using other money to put the whole amount back into the Roth. And that would be okay.
Yeah, I don't think he's doing that.
Well, let's just pretend, just humor me.
Okay, all right.
If he was.
But why would he withhold taxes, though?
Well, don't you have to out of a TSP? On a withdrawal?
Good point.
Like a 401k? So I think that's what he's doing.
He's nodding, by the way, for the listeners who can't see Joe nodding at Al.
So that's what I think. I think he's trying to make it whole with other money, and he can't get around the withholding. He tried to get around the withholding the year before, and the IRS got all over him, I guess.
Tim, move the money into an IRA and then convert the IRA to the Roth.
Yeah.
But don't withhold taxes on the conversion.
Right. Well, I agree with that.
Right, because then it doesn't. The conversion is probably not going to make sense if you're withholding. If you need to pay the tax from the front. All right, just all logistics aside, because what he's doing is a 60-day rollover into a Roth, and I don't believe he's making the Roth whole. I believe he doesn't have outside money to pay the tax.
Okay, well, that could be.
Right.
I mean, whenever you do a conversion, you should have outside money to pay the tax.
Right.
You're going to have to come up with it somehow. But
he's paying the tax within
But I do agree it's cleaner to go from TSP to IRA, because then there's no withholding, because that's a direct transfer from one fund to the other. And then you could do a Roth conversion. Obviously, there's no withholding, and then you just pay the tax when it's due. That would be cleaner. The 60-day rule, I think technically it works. But here's the problem is you can only do it once a year. And if you did it this year on April 2nd and next year you do it on February 28th, it's like you've blown it. Right.
So interesting. This is where people get into problems.
Yeah, I know. They hear snippets, right? And then they start doing stuff.
Right. And then they're like, okay, well, I'll show them and I'll work this way around. And because the other guy totally blew up that we were talking about before.
I remember that one.
He took a full distribution. And he was like, I don't know what the big deal is. I keep taking these distributions, and he's trying to do 60-day rollovers, but he did multiple of them that disqualified him.
Yeah, because the rule is you can only do one every
365
days. So in other words, if you do on April 1st, then you have to wait till like April 2nd of the following year to do the next one.
Right. So this is where, I mean, with the 60-day rollover, when he's trying to do a conversion, makes very little sense to me.
It's more dangerous.
It's way more dangerous.
Yeah.
Right. So I'm not sure why he's doing it that way. I'm guessing he's withholding taxes because he doesn't have outside money to pay the tax. He's paying the tax within the conversion.
Yeah. Well, if he's doing that,
Stop.
and if he's under 59.5, stop. Even over 59.5, there's not a lot of situations where we recommend that.
Unless there's millions.
Unless there's millions and you got no other money, and you're going to be in such a high tax bracket.
Right. So let's say if Tim has got millions in a retirement account in his TSP.
Yeah.
And he's also got a pension of like 150 grand.
Right.
And his wife's got another pension of another, 50 grand. I mean, right. So very high fixed income.
Right.
Super high retirement balances. No other outside assets.
Yeah. No non-retirement assets. Then I could, and you're over 59.5.
Yeah.
So I could see it then. And we have recommended in that situation, but it's unusual.
Right. We talk about conversions quite a bit, and most people think we're right. You're Dr. Roth.
Yeah,
Roth?
Dr. Roth. That's what
Roth brothers.
Roth brothers.
My fellow church practitioner, parishioner. Is that what you call it? Parishioner.
You practice church?
Yeah, I've been practicing for a long time. Anyway, that's what he calls me, Dr. Roth.
Got it.
Although he is, I won't say anything.
Okay. All righty. We got another one about Roth. So this is in regards to excess contributions to a Roth IRA. Richard writes in, question on excess contributions to a Roth IRA. If I'm over 59.5, do the earnings on my excess contributions to a Roth, will that be taxable? I don't think it should be taxable because it's coming out of the Roth.
Yeah, it's taxable.
It's excess contributions. You put too much money in.
If you weren't allowed to put it in, the earnings are not allowed either. That's why. So that takes care of that.
This is BS.
I think you guys are wrong.
Yes. So the whole term of excess contribution is okay, Richard. It's like you putting in, as a contribution, 50 grand. And letting the 50 grand grow.
Yeah, and it should, all that growth should be tax free because it's in a Roth. No, not if the.
But the rule is only $7,000 contribution, and you made a $50,000 contribution. You don't think that the excess growth is taxable?
It'd be cool if it could be. We'd all be doing $1 million contribution every year if we had it.
Are IRA annual contributions ever going up to $7,500? Preston writes in. Sure.
Yeah, the answer is yes. I actually, just for fun, I did a little analysis. IRA contributions started in, the limit in 1974. The first year you could do it was $1,500, and it stayed that way to 81. Then it was $2,000 for a long time till 2001. Then it was $3,000, $4,000, $5,000, $5,500. $6,000 started in 2019. The catch-up only started in 2002. So that's, anyway, yeah, it's always going up. Not every year, but over time.
Yeah, that's kind of an oddball question. Been always waiting my whole entire life to put $7,500 in versus $7,000.
I want to put $8,000.
All right, cool. Wow, we got Marcus writes in. We haven't heard from Marcus in a while, have we?
We have not. Tennessee.
Well,
where do we think he would?
Tennessee, Alabama?
Yeah, that's right.
That's
Alabama.
him.
Yep.
Hello, Joe, Al, Andy. I have a very, very, very important question for Big Al. Big Al, do you think Carol Baskin killed her husband?
That's reference to Tiger King.
Thank you.
Honestly, Marcus, I only watched like 3 episodes and I sort of got bored. So I would say she's a little off. So it could be, but I'm not going to say yes or no.
Have you seen those signs with Baskin Robbins? It's like no relation to Carol.
Yeah.
It's pretty funny.
Right.
Apparently not. All right. Just kidding. Don't have to answer that one.
Already did.
Here's my real question. Could you all explain large cap, mid cap, and small cap? Can a mid cap company eventually become a large cap company? Next, please explain growth and value. When does value stock not become a value stock anymore? I'm trying to logically understand the composition of value funds and why they tend to perform better in the long term. Lastly, how does, let's say, a small cap S&P 600 index fund differ from a small cap S&P 600 value index fund? They both should contain the same 600 companies, right? Thank you again for an informative, funny, and real podcast. Looking forward to multiple episodes of Your Money, Your Wealth per week.
He's been advocating for that for a long time.
He has. I remember that. Well, let's start with small cap, mid cap, large cap.
You can do the large cap, mid cap, small cap, and I'll do the value and growth.
All right. So that just refers to the value of the company, which they call capitalization of the company. So in other words, if a company is worth $1 billion in terms of market value, that's its capitalization. And so
it's just the number of shares outstanding times the stock price.
Yeah, to figure out the price per share. Yeah. And so when you're thinking of I'll go with a mid cap. A mid cap is generally considered to be $1 billion of value, capitalization to $5 billion. Although some people actually think it's a little bit more, but we'll just go 1 to 5 billion. That's mid cap. Large cap is above that. So those are larger companies. Small cap is below that. Very simple. Can one change from one to the other? Sure. As companies grow, they can go from one category to the other. And there are times then these funds that get reconstituted like a S&P value index type fund. A couple times a year, they may be kicking out funds that grow past now they're mid cap, and so they should no longer be in that particular fund. So yeah, that does happen all the time.
Okay, so value versus growth, real quickly on that. I guess there's a few different measures that some people look at to determine what is a value stock versus a growth stock. I think we look at price per book value.
Yeah, price to book value.
And so what that means is that a company, right, you have a market value, and then you also have a book value. So there are two different values. What is market value is the perceived value that the overall market, the stock market, believes that your company's worth. The book value is that what's your inventory?
What are your assets?
What's your assets, right? You have a balance sheet. I have, desks, computers, and blah, 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 blah. And so there's...
Yeah, and maybe you have technology that you capitalize, or maybe you bought some other companies, and so you've got that capitalized. So all that stuff added together is your book value. And then you sort of compare that to the market value.
So if the market value is lower than the book value, that's a value stock. If it's higher, it is a growth stock.
Yeah, that's oversimplification, but that gives you the idea, right? And so another way to think about this is a value company is one that the stock price is beaten down for whatever reason.
So if everything is liquidated, the assets themselves are worth more than the overall stock price that's trading on the exchange.
Yeah, and if you think about it like a value stock, it's that's like a stock on sale. And that's where Warren Buffett likes to make his money. He buys value stocks when they're on sale. He doesn't like to pay full price or excess price.
So that's why you will see over time, and this is not true in all cases in all time frames, as we've experienced, value stocks have underperformed growth stocks. But over a longer period of time, value stocks will outperform growth just because there's more risk associated with those types of companies, and you're compensated for that risk.
Yeah, there's a reason why the stock price is lower. So it's more risky to invest in that company. Hopefully it does a big turnaround. And interestingly enough, because the stock prices are cheaper, if you look at a basket or an index fund that has a whole bunch of companies, they tend to outperform over the long term. But you're right. I mean, we've had 5, 6, 7 years straight where that's not been true. Growth stocks have outperformed. But over the long term, value stocks, because there's more risk, perform better.
And so there's called mean reversion. So what that means is, let's say you have a company that is doing poorly or an industry that's doing poorly, right? So what happens with that industry is that all of a sudden, a lot of the companies that are in that industry go out of business, and then all of that business goes to the strong that survive. And what do you think happens to that stock price over time? It goes up because, right, it made it past everything, all the BS. But everything is true on the other side too. So if there's a certain industry that is gaining a lot of interest and people are making a ton of money in a certain area, what happens? They create more competition. as more competition is created, what happens to that stock price? It will go down. So that's why we believe in indexing, just so you're buying all the companies, because it's very difficult to determine, right, who's going to make it and who's not. Like airlines. Who would have predicted the pandemic? And then all of a sudden you look at, all right, well, is American Airlines, are they going to make it through? If there was no government bailouts, who knows?
Right.
Alaskan Airlines, Spirit,
Sure.
who knows what the fallout is going to be. And then so to go back to your S&P 500 value index versus growth index, is it the same companies? It could, but it's how that index or how that ETF, and I'm not sure if he's looking at an index fund or an ETF.
Well, he says index, but I don't know. He says small cap S&P 600 and a small cap S&P 600 value index funds.
Aren't they the same 600? To be honest with you, they could, but I doubt it.
I doubt it too, because I think the one is going to have all value funds, and the other one is probably going to have some growth in it.
I still think it's not going to have all value. I think it's still going to be tilted.
It's maybe
towards
tilted,
and then it's going to look at the market cap of the overall, right?
Yeah,
of those companies, and that's how they're going to construct the ETF or the
yeah.
or
And
the
you'd have to go to the specific index or fund, because everyone's going to be a little bit different.
So, but there's your elementary version of value versus growth and large versus small. Good to hear from you again, Marcus. Hopefully that answers your question. Keep them coming. Always like to. Hey, has Marcus joined a webinar? I don't think.
Yes, he has.
Oh, yes. All right. Well, very cool.
Register for tomorrow's live YMYW webinar happening at noon Pacific, 3 p.m. Eastern. Check out our blog post on value stocks versus growth stocks in the podcast show notes at yourmoneyyourwealth.com, where you'll also find links to previous relevant episodes of YMYW, including a primer on the basics of investing and an explanation on determining the best asset allocation for your retirement portfolio. In other words, how much of those small, mid-cap, and large-cap, and growth and value stocks you should have in your portfolio. Click the link in the description of today's episode in your podcast app to access all the free financial resources you've heard mentioned and to read the full transcript of the episode as well, because that helps sometimes when you're trying to make sense of Joe and Big Al.
Andy writes in.
No, I don't.
Different Andy.
Yeah.
He goes, hey, folks, hope you are safe and we are exiting the pandemic. 3 comments. Hopefully, I'm not wrong. Number 1, this was an interesting add to the Roth conversion discussions. If your spouse or you have only IRAs, no SEPs, no IRAs from old 401ks, 403bs, mainly non-deductible IRAs. Your exposed balance using the aggregation breakdown may not produce as much of a tax load, especially in a down market. Thus, for me, with some SEPs or unique IRAs, it makes it wiser to convert more of hers versus as her tax load is lower. Okay, did you follow that?
I think he's talking about the aggregation rule and the pro-rata rule. And so it sounds like his wife, spouse has less tax consequence of converting. And yeah, absolutely. Then convert that first.
But let's just make sure that people understand the aggregation and pro-rata rules.
Sure.
And it's not based on couples. IRAs are individual retirement accounts.
Yeah, and I think maybe that was kind of a breakthrough from him. He didn't realize that. So each one stands alone for purposes of this rule.
So let's say Andy has IRAs that are all non-deductible. And so he was like, you know what I found interesting is that because markets went down, my account balance went down, but I still have the non-deductible contributions.
Mm-hmm.
So if I did the conversion, let's say he did $50,000 of non-deductible IRA contributions and the account balance was worth 60.
Yeah.
The market went down. Now it's worth 52,000.
Right.
Well, he still has $50,000 of basis, even though right?
Yeah, there's no change there.
So when you convert, now he's only paying tax on 2,000, let's say, versus 10.
Yeah.
So you are absolutely right there. But the aggregation and pro-rata rules from a non-deductible standpoint of what's taxed and what's not is based on you, Andy, and your spouse.
Yeah,
so
separately.
Separately. So let's say Andy's spouse has all SEP or pre-tax dollars. Andy has all basis in his or her retirement account, don't aggregate the two spouses together. Just separate them, and I think your math will turn out pretty good.
So I'm agreeing with that comment.
Because it makes it wiser
to convert more of hers first as her tax load is lower. So whichever spouse, whether it's you or her.
But why is okay? Yeah. So
well, he started by saying if your spouse or you. That's why it got confusing. Which one is it?
If your spouse or you, maybe Andy doesn't have any. But then it goes no SEPs, no IRAs from old 401k, 403b, mainly non-deductible IRAs. Okay.
Yeah.
Your exposed balance using the aggregation breakdown may not produce as much of a tax load, especially in a down market. Thus, for me, with some SEPs or unique IRAs, I don't know what a unique IRA is.
I guess he's saying SEP is a unique IRA.
Okay.
So it still counts as an IRA.
Okay, so the spouse has the non-deductible IRAs.
That's or a 401k or a 403b. So
yes, convert that
first.
Yes. That's fine.
Okay, we got that.
Oh, God, if the next two are like this, it's going to be painful. Oh, geez. Maintaining your funds in an old 401 can be benefit with ERISA protection for some specialties. Of course, this assumes satisfactory investment options and fee. Some states do allow lawsuits to tap IRAs in certain values. Okay, we don't talk about this enough. And there was a comment, I think, in our webinar too, or maybe it was one of my webinars that I did or something like that. It was like really good content, but you're missing some protection laws.
Right.
So 401ks and IRAs, right? In regard into there's ERISA protection. So if he gets sued. So there's two different types of protections. One if you get sued, and then one if you file bankrupt.
Yeah, and they're two different things.
So retirement accounts are protected under bankruptcy. So if you rolled a 401k into an IRA, you still have the same protections up to a couple $1 million.
Yeah, and if you have an IRA that was originally an IRA in California, it's a little under 1.4 million that you get protection on. That's on bankruptcy.
Bankruptcy
only.
So 401k, you roll into an IRA, it still follows that.
Yeah, so
that protection rule from 401k dollars.
Yeah, so we're talking bankruptcy now.
If you get sued because you ran over someone's dog.
Or like, as he says, certain specialties, certain professions, you're more likely to be sued. Like a doctor, for example.
Sure. Or CPA.
Yeah, right. Yeah, right. So, and so then it's a different answer, right? With the ERISA plans, you get protection. IRAs, you don't.
Depending on the state.
Depending upon the state. And basically, as I understand it, I am not an attorney, so take this for what it's worth. My understanding is the courts will determine what's fair in terms of how to divvy that up in a judgment.
Yes. And it's complicated.
Yeah, right.
So. And
it's not, it could be anything, right? So there is a danger.
There's a risk.
Yeah.
Okay. All right. My understanding is that, one, some banks will use your funds to produce a steady drawdown. And two, some mutual fund families or 401k sponsors will coordinate RMD distributions, which allow you an income stream without losing them into an annuity product, which is lost when you or your spouse passes. Thus, wouldn't your only wild card be isolated IRAs with individual RMDs? Couldn't you just consolidate these to ease RMDs? Yes, consolidate to ease the required minimum distributions. If you have multiple IRAs, you can take one required minimum distribution and satisfy the required minimum distribution just out of one IRA from multiple. If you do have multiple accounts, such as a 401k, let's say you have 3 401ks in an IRA, you're going to have to take required minimum distributions out of each of those different accounts.
Yeah, and I think that's confusing to a lot of folks. So IRAs, no matter how many you have, you can pretend they're one account, take an RMD from one account. 401ks, 403bs, that sort of thing, got to take an RMD from every single one you have. So if you had 6 employers and you kept all those 401ks, 403bs, you have to take an RMD out of each one. So it's a good idea to consolidate those at some point.
So I'm not sure why he's saying some banks will use your funds to produce a steady drawdown.
I don't know what that means either, because he's suggesting if you don't take enough out, then the bank's going to put into annuity. I've never heard of such a thing. Right? Is that how you read that?
Yeah. Unless he's still talking about protection because of the overall retirement account, because it's still going to be state by state. And are they looking at what income that retirement account produces?
Maybe, but he specifically says it putting them into an annuity product.
Well, I guess if you convert your IRA to an annuity, that's an income stream versus an asset.
Yeah.
So some people try to skirt certain things, right? Because you've got asset laws and income laws. And so you can't, so I don't know what he's really asking there.
I'm not sure either. We don't know what state too, so we can't, every state's a little different.
Yeah, that's why it's imperative you let us know where you're calling from, folks. Because we can just...
And if you're from California, we can help you. And if you're not, we'll just do our best.
Your insight and comments make this subject easier to understand. My wife now takes her walk listening to podcasts. But it doesn't really say our podcast. So she gets more familiar with financial terms. Essentially, when I wax on, it's not Greek to her. Wash your hands frequently and don't touch your face. But what the hell's Andy doing with his wife when I wax on?
When he goes on and on about finance, his wife actually understands better because she listens to this podcast, is what he's saying.
Oh, wax on?
Yes.
Okay. Thinking about something else. I didn't know it was like you're
waxing
going on
philosophical,
No.
Yeah, it's that's how.
If I've ever said wax on, it's not that I'm talking a lot. I'm using, it's like maybe the Mr. Miyagi.
That's probably a
wax on, wax off.
Maybe that's slang for wherever Andy lives.
Yeah. So keep waxing on. And she could get familiar. Because the way he writes, man, I feel bad. She needs to listen to this podcast because if he talks like he writes,
he'll probably have a better understanding of you because her husband is kind of talking in circles like you do.
I'm not talking. The reason why people say I'm talking in circles is because I'm reading verbatim of what the hell they're writing to us.
Right, Joe.
And your answers
must
are
be it.
solid.
Dude,
Tight.
Yeah.
You read this.
Did you just say dude?
You got me all fired up. I was waxing on.
I'm going to start using that. It's just Joe waxing on again.
What are you doing? I'm waxing on. Leave me alone.
I'm talking to myself. I'm waxing it up.
Oh, boy. Yeah. Wax on. Well, wax on a little bit.
This is good. We could have a whole new dialogue here.
Oh, God. I'm sweating now.
Stick around for that big old derail I mentioned. That is if you don't mind giving up 4 minutes and 23 seconds of your life that you'll never get back. Your Money, Your Wealth is presented by Pure Financial Advisors. Click the free assessment button at yourmoneyyourwealth.com or call 888-994-6257 to schedule a free financial assessment video conference with a certified financial planner from Pure. There's no cost and no obligation. It's just a deeper dive into your financial situation to make sure you're on track and to help you make some money-saving moves for your future. Schedule that free financial assessment by visiting yourmoneyyourwealth.com or calling 888-994-6257. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision. We'll see you tomorrow, folks. Sign up for that webinar.
Arizona's more open than California.
Oh, Arizona never shut down.
Yeah, I don't think so, right? I can get a haircut even if I want.
You did a really good job yourself.
Yeah, it's
Gotta go to Arizona to get a haircut.
I read some dude drove 600 miles for a haircut.
Oh, is that right?
I'm like,
Was it you?
Clickbait.
No, he's got his barbershop.
Yeah.
How's that doing, by the way?
It's
close.
COVID. We're done.
Cash flow.
COVIDed.
We're done.
PPP loan.
Yep. Put a little fork in that endeavor. Yeah, basically kind of. Well, my partner's a barber.
Yeah.
So he's not very fiscally
Right.
responsible.
Yeah.
I'm not saying that all barbers are not fiscally responsible, but
What I liked about that shop was you got a beer when you're getting your
yeah,
haircut.
you got a beer.
That was
If you
kinda
want
cool.
some Jameson or something.
Yeah.
Very easy. Very. Yeah, because you needed to get real buzzed. Because these guys would just butcher the hell out of your hair.
You wouldn't complain so much. Oh, it looks fine. Don't worry about it.
If we would do a thing, or not me, because I'm not cutting the hair, but they would not. If you go to like a normal barber, there's a mirror.
Yeah. No
And you
mirror.
can
No
see
mirror
what-
there. Yeah, what they're doing.
No, they flip you around.
So you can't see.
You can't see.
They don't want you to see.
No, and then at the end, it's
like,
a big
oh.
reveal. And then so some people would be like, "Oh, awesome," and then others would be like, "Oh."
That's not what
That's
I
why we
told you.
gave beer and J-Mo away.
Got it. Makes sense. Could have got a mirror. Would have been cheaper.
Well, we had a mirror, but you just couldn't see yourself in the mirror as they were cutting your hair.
No, you should put one on the other wall so you could see it the other way.
Well, I guess you could if you kind of look, but then you're
There's
they wanted it because
stuff in
you're
the way.
talking. You're talking to other people that are going to cut.
Oh, you're socializing.
Yes,
It's
it's a barbershop.
kind of like a bar.
Must be old school.
At a
Yeah, it's
barbershop.
old school barbershop.
Yeah.
Right? Try to get a little shoe shine in there. So people
Got it.
see
Okay, very cool. Yeah.
So, yeah, that's gone. That's tough during COVID, tell you that.
Yeah.
But, I
it is
mean-
stuff. Yeah.
So one of my guys is like, man, I can make, a few $100s just traveling to cut these people's hair. But you gotta, hide in an alley.
Yeah.
Yeah, don't you lose your license if you cut hair while this is all happening?
I have no idea.
You're not in the barbershop business anymore.
I'm not really.
He just
Yeah.
owns a barbershop.
I'm a private investor of a barbershop that failed miserably. Any other questions, Andy?
No, I'm set.
All right.
So we got a couple of minutes to answer this 3-part question.
You got it. How did you hear about the whole licensing and?
That's what
As a private investor, I don't need to know that stuff.
The lady that takes care of my hair told me. She said we're not allowed to see anybody because we will lose our license. So the lady that
Well,
works
you
at
have
the
a
salon,
perm, and that has a lot of chemicals in it.
right?
versus just.
I don't know. I think your hair looks pretty straight to me.
Yeah.
So, but yeah, that's kind of. So, are you going to get a haircut instead of one?
I don't know. Maybe. I did such a good job with my wife. Of course, I can't see the back. I have no idea what's going
It
on.
doesn't look that bad.
No way.
I cut my husband's hair. I took care of his hair, and I'm taking care of my own bangs. And actually, when we did a webinar the other day, my mom was like, "You need to straighten your bangs." I said, "They are straight." She said, "Oh, it looks like you gave yourself a bad haircut." I said, "I did."
Yeah, I think I told you I was up in Idlewild and I started doing the sides with the razor, and Anna was going, "Oh my God, you're doing way too much." And I go, "It's okay." But
Like
then
a razor? What do you mean? Like a clippers?
So yeah, clippers.
Okay,
Yeah,
all
clippers. Yeah. Yeah, a razor. I was shaving it down. No, I think I used like a 7, but
Low guard?
yeah, a little guard, but it seemed like it was cutting about a 2.
Just
Yeah. Yeah. So then anyway, so she started doing the top with scissors and was afraid to cut very much, so we didn't get very far.
Got it. All right. Well, I think
We'll get back to the question later.
Yeah, we're slowly opening up.
Yeah.
So which is good news.